if you look at M2, money supply chart, and look at its increase, where was money supply in 1980? Where's M2 now? What's the percent gain in the money supply? Degradation in the money unit. Silver would be at $300 to $500 right now, just to match the decay in the money supply. So silver is a lagged beast. Now, there's arguments why it is. It's not fundamental. It's manipulative.
Quick favor before we begin: if you enjoy this video, don't forget to like and share it. Every like and share helps YouTube recommend this video to more people, which really helps the channel grow.
Tracking the explosive trajectory of the global M2 money supply reveals a shocking long-term degradation of our purchasing power. This persistent debasement of paper currency has quietly established a highly explosive launchpad for tangible, physical safe haven assets that have historically lagged behind real-world inflation. Offering a crucial perspective on this trend, Michaeloliver, a legendary momentum analyst and the pioneering founder of momentum structural analysis, highlights how this silent devaluation has created a monumental pricing anomaly within the precious metals market. He demonstrates that silver is a heavily coiled spring whose physical pricing error has been artificially maintained for nearly half a century. By analyzing the raw decay of fiat currency since 1980, he projects that silver prices must inevitably surge to between $300 and $500 per ounce, simply to align with the historic expansion of the monetary base. This inevitable correction is further accelerated by a severe, multi-year structural deficit where global mine production falls far short of rapidly expanding industrial demand. Now that the metal has finally shattered its long-term resistance ceiling, this monumental catch-up phase has officially begun. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The silver thing is bizarre. I mean, it almost doesn't make sense that you'd have 5 to 6 years now of deficit of production to demand, the industrial side of silver. They can't mine enough to get it out to match the industrial demand. Okay. 5, 6 years. So the timing is a key issue. It's a technical issue because those fundamentals have been there. And yet silver sat on its butt for 50 years, the last 5 especially. And only was late last year that it finally said, I'm going to get out of here. Okay. So that's kind of weird. So it's really a technical issue there. But it is monetary metal. And when you compare silver, you want to say, I want to buy cheap, not expensive. Well, when you measure silver versus gold, right now it's about 1.5. We divide silver price into gold the way we do. We don't do the ratio scale. But if you divide an ounce of silver into gold, it's like 1.5% of the price of gold. If you go back to the 1980 peak, silver was 6.5% of the price of gold, its relative value. In the 2011 peak, when silver also hit $50, it was 3.1% of the price of gold. And right now it's 1.5%. So forget the net price direction. When that spread breaks out, as it did last November, and the pullback has not negated that recently, by the way. If you take that spread up just to the 3.1%, let's get it back to the last 50 years of highs, which is 6.5 and 3.1. Okay. If you even just went to 3.1, you double the value of silver versus gold where it is now. So as gold goes up, silver's going to go up double as much just to get back to where it was in 2011. If it ever went back to the high of the last 50 years, which price is already taken out, but the spread would be at 6.5%. It's like a quadrupling of the price of silver versus where it is now to gold. So our argument is, and by the way, when that spread advances favoring silver, it's always associated with an uptrend in both metals. In other words, silver doesn't advance versus gold in a downtrending metal market. That spread, if it goes up favoring silver, means the net price of both will go up. Base metals and gold, going back to like 1980. That's when silver was $50. Okay. Silver went to 50 again in 2011, still confined in the box for some reason. But you look at like nickel, steel, aluminum, copper, lead, gold. You plot all these charts, and this is massive parabolic move where we're trading 3 to 10 times higher than we were in 1980. How come silver, the baby monetary metal, but still thousands of years has been monetary metal? I think the Indians are shifting toward it now, in fact. How come it's only $5 above its 1980 high? And we put an arrow on these charts of these, like all these metals, and showed where they would be if they were matching silver right now. They would be all the way down to the bottom of their page practically. In other words, why is silver not done what all these metals have done since 1980? Trade at many multiples higher than that. Oh yes, and zigzags and so forth. But I mean, gold in 1980 was $800, $850. It was a peak of that bull market. Silver peaked at 50 then. Okay, where's gold now? It's been trading 4,000 to 5,000 versus an old high at 850. Gee, if silver were doing that, where would it be? You do the math on it, you get the point. The other thing is, if you look at M2, money supply chart, and look at its increase, where was money supply in 1980? Where's M2 now? What's the percent gain in the money supply? Degradation in the money unit. Silver to be at $300 to $500 right now, just to match the decay in the money supply. So silver is a lagged beast. Now, there's arguments why it is. It's not fundamental, it's manipulative. But obviously, those who've been trying to restrain silver haven't succeeded because they couldn't keep it in the box. Late last year, we broke through the 50, okay? And we think it's only begun. After all, you broke through a half-century range. You surged for a couple months. That's the end of it. Think about it. Half a century range, you break out above it, and you don't even, when you look at the logarithmic ratio scale of that range, it's a tenfold range from bottom to top. $5 to 50, $5 to 50 for 50 years. When you go back and look at other metals using a ratio scale chart, and then look where they are now in that, you've easily doubled the range. If silver doubled its range on a ratio scale, it'd be $500. Why? Tenfold range above 50. 50 times 10 is 500. So again, there's so many numbers that come up with, whether it's against the money supply, matching other metals, the ratio range of silver's range prior and the breakout, if you simply double the range on a ratio scale, all keep coming up with numbers 3 to 500. So now it's not a precise technical level, but it's the kind of thing you should expect. And quite often when these tantrums occur, they even overshoot reality. Which when you've been having an error for 50 years in pricing that no other metals had, and when you want to make up for it, quite often you'll even over make up for it. So don't be shocked by what you see on the other side of this. That's our assessment. The key now is, do we come out of this intermediate process of decline with an upside signal? And I'm telling you right now that not far above today's highs on a weekly close, we'll start to engage those factors to the upside.
Looking closely at the gold-to-silver ratio reveals an extraordinary valuation mismatch, with silver currently trading at a rock-bottom 1.5% of gold's price. A straightforward reversion to its previous major peak of 3.1% would instantly double its relative value, meaning silver is fundamentally primed to outperform gold by 2 to 1 as this secular bull run intensifies. Historically, when this specific ratio breaks out in favor of the white metal, it acts as a massive tide that lifts all commodities, including copper, nickel, and gold itself. If we project a doubling of silver's historic range on a logarithmic ratio scale, it easily yields a long-term price target of $500 per ounce. This is not some minor, short-term cyclical fluctuation. It represents a rapid, structural repricing of physical tangible assets that will completely catch mainstream portfolios off guard as the global precious metals squeeze accelerates. Investors who recognize this gap early are positioning themselves for an unprecedented wealth transfer as the spread aggressively corrects. Now, let's get back to the interview.
I think a new reality is coming. This is not a normal gold bull market. This is something that will change things that have been institutionalized for the last 100 years, fiat currencies. Central banks will become laughingstock, in terms of what they do and what they've done. Okay. So I think a lot of things will change, and I think gold knows that. A to Z, massive price moves, 5-fold, 10-fold moves. We're somewhere in the midst of that was one hell of a sell-off. And no doubt everybody in that market at that time said, oh, that's it, it's all over. And then when it wasn't all over, and you took out that peak, that prior peak that they thought was the top, you go absolutely parabolic because there's total uncertainty. You've already washed out all the week longs, and suddenly everybody's going to grab for it again because they realize the reason that it's going up. Right now, nobody seems to know why gold is going up. Very few anyway. And we argue that it's always underlying, yes, with up waves and down waves, but underlying it's a degradation in the money units. If we didn't have fiat currencies, gold would have been stable for the last 100 years. The only reason gold's going up is the fiat units are going down in real value. As the crisis proceeds, especially in the Western world, where they're not acknowledging this, they're totally fiat, happy with it, okay? Well, they're going to be unhappy with it because even academicians who've been supporters of the Fed will begin to say, and already are, that, you're not in charge of jack shit. Something's wrong here, especially when we hit the crisis, especially when the stock market breaks, because that's where the average guy feels gut kicked. Right now, the average family, the only thing they can smile about is their portfolio. Their retirement account has been incrementally rising. Not exploding, but, each year, another 10. So it's the only thing they got to smile about. It's certainly not their credit card over the limit and maxed out and 90 days past due. It's not due the mortgage rates. It's not, all that stuff's negative. But when you break that stock market, you'll have wave effects also, like job. The job market changes with the stock market. It doesn't lead it. You go back and look through history, for example, .com top, 2007 top. You don't get a real negative shift in the job market. The data the Fed likes to look at, how good's the economy, the job market. That data doesn't go south hard until the stock market is already broken pretty substantially. So looking at the job market now and saying, like Warsh just said today, the economy's in good shape, but the job market looks good. He doesn't link the data to history. It never shows negative and bad until you're months off the high in the stock market. Then they start to have the layoffs. And that's when the average guy, one, his portfolio goes down. That doesn't feel good if he has one. And two, his wife got laid off, or he got laid off, and they got 3 kids. That's when the stock market creates emotion, and emotion creates doubt and fear. That would be the emotion associated with this. And that's when you get the tone of panic. No longer is it incremental. It's now, oh my God, type of action. And it wouldn't just be with the average guy on the street, because the top wealth guys are going to be hurt by this too, because they're no doubt heavily in the stock market. And they're going to get gut kicked real hard. So it's going to be a widespread panic. That's when this type of shift that China is doing will become more likely elsewhere. And I suspect the West will be the last to do it, which seems kind of funny, doesn't it? You have what used to be the communist country. They still use the name Communist Party, but frankly, their economic policies don't reflect anything that Mao might have said. Okay, they have private roads, et cetera, et cetera. Anyway, people will then look, even the West might say, that was a good idea. Maybe fiats aren't particularly stable. Maybe they create instability. Maybe we need to do something like that. But it's going to take a crisis to provoke that change. And likely that crisis, the onset of it to the panic point, will be very brief. It's not going to take a year to get it into a panic mode. Once it starts to break, stock market especially, that's when you will move into a global economic downturn and emotions associated with it. And that's when people rethink reality. And those in government power rethink reality, or somebody takes their place, like in Argentina. Javier Milei kicked out the 2 prevailing, effectively socialist parties that had been there for decades. And he's cut government. So, countries like Argentina probably will survive this better than we will, for obvious reasons. Anyway, that's the thing we're facing. And I think gold is sitting on top of this powder keg and knows it. And this recent pullback does not alter our long-term trend assessment of gold and silver at all.
A profound macroeconomic transformation is quietly unfolding, preparing to permanently dismantle the institutionalized fiat currency systems that have dominated the global economy for the past century. When the highly overextended stock market inevitably fractures under its own weight, it will trigger an immediate, devastating domino effect, rapidly evaporating household retirement wealth, stalling the labor market with massive corporate layoffs, and unleashing an unstoppable wave of global panic. Central banks will likely find themselves exposed as a complete laughingstock as paper money enters a state of rapid terminal degradation. Gold and silver are currently sitting directly on top of this massive monetary powder keg, quietly anticipating a severe systemic crisis that will force governments and societies to fundamentally rethink the nature of real value. Much like the sudden political and economic shifts seen in places like Argentina, this looming crisis will provoke a swift, aggressive transition toward hard, unbacked assets as fiat structures fail. While the mainstream financial media remains completely distracted by short-term market pullbacks, the smart money is quietly accumulating physical metals in anticipation of an inevitable parabolic upside explosion. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.